Hello, everybody, and welcome to a special edition of Hash Rate. My name is Mark Jeffrey. This morning, I gave a presentation to the LA CEOs group at Upfront Ventures on Web3, and I put together a deck and kind of went over the basics of what it is and what's happening now with a pretty big focus on DeFi. And so that went pretty well, and I had a lot of compliments on it, so I thought I would give the presentation here in hash rate as well. Why not? Why let it go to waste, right? I did all this work to make a deck and figure out the presentation. So I'm just going to repeat it here and throw it up online. So here's the presentation on Web3. So who am I? Why should you listen to anything this guy says? Well, I'm the general partner of the Bullion Fund. I've been a full-time investor in the space for 2 years, but I've been in crypto for 10 years. And I participated in the Ethereum ICO, which was a 15,000x event, so pretty good. I'm also the author of a book called Bitcoin Explained Simply in 2013 and The Case for Bitcoin in 2015. And currently I'm the host of Hash Rate, this podcast, and a co-host of the Across the Chains podcast. We cover news every week in the crypto space in kind of a McLaughlin group kind of format. And I co-founded the very first metaverse on the internet. As far as I know, I think it was the first one on the internet, called The Palace, 1995 through 2001. It was backed by SoftBank and had 10 million users at its peak. Okay, so quick definition. What is Web3? Well, in the olden days, we logged into the web with a username and password, and then we started logging into the web using our Facebook and Twitter handles, and then along comes Web3, and now we log into websites using our crypto wallet. So that is our identity on this new version of the web. And this opens up some interesting new possibilities. Web 1 was read-only. Web 2 is read and write. And Web 3 is read, write, and own. You can actually own digital assets and interact with the website with the digital assets because you are connecting with a crypto wallet. And this opens up some incredible new business models. And I feel this one pretty deep in my heart because even though the Palace was this giant phenomenon, and we actually had 10 billion user-generated assets, which we would now call those NFTs. It was a huge phenomenon, but we couldn't monetize it. It was not monetizable. But had we had Connect Wallet, it would have all been, the behaviors we saw would have all been extremely monetizable. So first, a little word about smart contracts before continuing. So smart contracts, they're kind of inert. They're like viruses. They can't just wake up on their own and do things like most software. Some outside force, usually a wallet, has to act upon the smart contract and set it into motion. So because of this, it incentivizes wallets to help it do things by offering fees or arbitrage opportunities. So in effect, the smart contract will pay you for helping it out. And this makes possible this new class of stuff called DeFi. So DeFi stands for Decentralized Finance. And the entire space, in one way or another at the moment, basically breaks down to fractional citizen ownership of banks and exchanges. Now, I don't mean ownership in a stock sense. It's not that. It's ownership in the sense that you now make the fees that banks and exchanges used to make. Because in this decentralized finance world, no human institutions are required. There are no third parties. Instead of these, there are smart contracts. So you can think of these smart contracts as just robots in the sky. So you have robot banks and robot exchanges. But these robots, in order to operate, they need coins. They need liquidity. So what do smart contracts do? They incentivize you to help it out. And so they basically say loan coins to the robot as an exchange or a bank, and you, end user, can earn money. Now, over the course of 2022, which was a kind of crazy year, we had multiple black swans. And so this really was an extreme worst-case stress test for the entire DeFi robot bank smart contract contraption. And it passed this extreme stress test with flying colors. Everything worked perfectly. And if you've ever used DeFi yourself, if you've actually touched the wallet, if you've done the work, and use the protocols and use the wallets, you can just feel the raw power of it. Like, you can feel where this is going to go. In some way, this is how all of human finance eventually on Earth will be done. And it's very much like using Mosaic for the very first time if you're old enough to remember that experience. Another big characteristic of DeFi is that different smart contracts can be combined to create entirely new financial instruments. So DeFi protocols, DeFi smart contracts, they're composable, they're stackable, and some people call them money Legos. And because of this money Lego-like nature of these smart contracts, it produced this giant Cambrian explosion of innovation over the last 2 to 3 years. And so how big was all this? Well, it went from 0 to 200 billion in 2 years, so pretty insane growth curve. Because of the events of 2022, that has now been clipped back to around 50 billion. But at its peak, DeFi in aggregate would have represented the 31st largest U.S. bank by total assets under management. So pretty big. The 50 billion that's left over is sort of spread out over multiple layer 1 protocols, with Ethereum being at the top, and then Tron, Binance Smart Chain, Arbitrum, Polygon, Avalanche, Optimism, Phantom, etc., on down to other things like Solana and other things you've probably heard of, and then a whole bunch of things you probably haven't. Here's the same information presented as a pie chart. As you can see, even now, it is mostly Ethereum. During the run-up from 0 to 200 billion, Ethereum started off with 100% of the market share, and then as all these other clone chains or EVM chains, basically people who cloned Ethereum and fixed it and made it more efficient in some way, a lot of those chains arose over this 2-year period. Ethereum lost more than half of its market share during this period. So it was less than 50% of DeFi. And with the merge, which happened in the fall of last year, which was a pretty big upgrade to Ethereum, Ethereum has now regained a lot of lost ground and is now sitting at around 60% of the total market share. And then the remaining EVM compatible chains. So these are, EVM means Ethereum Virtual Machine, and it basically signifies that chain is compatible entirely with Ethereum. Smart contracts on Ethereum will work. You just cut and paste them onto these other chains and they will automatically work. So think of Ethereum as like, the IBM PC, and all these other chains are like Compact, Gateway, Dell, etc., all completely compatible with one another. And then things like Solana are not compatible. So the Solana, you can think of it sort of like the Amiga. It's better in some ways, but it is in no way compatible with the IBM PC universe, if you will. So Ethereum and its clones comprise about 80% of DeFi right now. Solana and the things that are not compatible are, the remaining 20%, more or less. And their share of this whole thing is shrinking right now. It could come back. We don't know. So, anything can happen. And I would even go so far as to say that Ethereum and its clones might be the MySpace. So this layer, who is going to be the final layer 1 winner? It's anybody's guess as to how that's going to go down. It could be one chain. It could be multiple chains. We just don't know yet. Okay, so the big thing that kicked off decentralized finance fundamentally was the invention of Uniswap. So the Uniswap DEX, or decentralized exchange. So Uniswap, it's very, very easy to use. As you can see, it's a very clean and simple user interface, especially when you compare it to this. And this is what we were all dealing with before Uniswap came along. Centralized exchanges, besides being quite a bit more of an eye crosser in terms of a UI. And granted, they've improved quite a bit since the early days when they were all like this. Examples of the centralized exchanges, which are human-run, centralized companies, FTX, Binance, Kraken, Coinbase, etc. And all of these centralized entities require permission listing for your coins. So you can't just come along and put your own coin on these exchanges. They have to approve you. And generally, it's about $1 million in listing fees, and just for the pleasure of being listed. And then they require you to do market making on top of that. So that's another $30K a month required. On top of that, you might still get delisted at any time. So the exchange may just decide to kick you off the exchange for whatever reason. It could be any number of random reasons. So as you might guess, this world is kind of controlled by cabals and mafias. If you're in the end club, you get on the exchanges. If you're not, then generally, not always, but generally you don't. But that all changed completely with the invention of Uniswap. So first of all, anyone could list any coin at any time. You want your coin on it? Great. Just put it up. It's easy. Second, there's no $1 million listing fee. Listing is free. So that went away. Third, the market making was included, and you have to pay nothing for it. So just the very nature of the way Uniswap works, market making is just a side effect of how it operates. In fact, these things Uniswap and its clones are sometimes referred to as AMMs, which stand for automated market makers. So because there's a bunch of liquidity pools, which I'm going to get to in a second, that is the market maker. That is the counterparty which always buys any demand for coin sales inside the entire system. So it's important to realize that Uniswap is a DEX, a decentralized exchange. It is made of pure smart contracts. So it is a robot in the sky. It is a robot exchange. So this forms the first pillar of DeFi. The second one is lending, which is basically robot banks, which we'll get to that in a little bit. So underneath the hood in Uniswap are these 50-50 liquidity pools. All it is a collection of these pools. When you're trading on Uniswap, you're trading in and out of these pools. So what we're looking at here is the USDC Ethereum pool on Uniswap, a pretty popular pool. There's about 200 million in this pool right now. 122 million of it is USDC, so that's a stable coin, so dollars. And there's about 80 million in Ethereum. So it's a little out of whack, right? So it's more like a 60-40 pool at the moment. So the Uniswap, these pools always want to try to keep themselves into 50-50 balance. So at the moment, this pool is hungry for your Ethereum. It wants your Ethereum. So it will pay you a premium for it, right? What do smart contracts do? They incentivize you people out there to do things to help it do the things that it wants to do. So right now, ETH is at a premium in this pool, so it gives you an arbitrage incentive. Now, the other thing that these pools do, and Uniswap as a whole does, and decentralized DEXs, decentralized exchanges do, you make money by loaning coins to the Uniswap pool. So that 200 million, where did it come from? It came from you. And the reason why you people out there gave it 200 million is because you are earning transaction fees on any trades in and out of that pool that you put money in. So what you're looking at here is actually Spooky Swap. So it's a Uniswap clone, but it's the same thing. So if you can see the USDC Phantom pool, which I have highlighted, you're making 28.9%. So call it 30% APR, and roughly 25% of that is transaction fees, and 5% of that is the Boo token. So Uniswap and Boo both have their own protocol tokens, which they will give you on top of the transaction fees as sort of a bonus on top of what you're earning. Now, when you put your money, when you put your coins in the pool will give you back a different set of tokens called LP tokens, and LP stands for Liquidity Provider. And these tokens, these LP tokens, are your coat check. They say that you deposited X amount of coins in this pool, and this coat check is how you get those coins back when you're done. Also, as your transaction fees and other winnings collect up in the smart contract, the LP tokens are how you retrieve that as well. So it's your coat check for your winnings also. And because of this feature, the LP tokens, the coat checks, are also, in a sense, money. Because if I give my LP token to you, you can get my stuff. And so because these LP tokens are sort of money-like as well, they are part of what helped formulate the money Lego-like nature of all of DeFi. So you can take these LP tokens and you can then deposit them somewhere else to get some new benefit. So I am going to come now to a place called Beefy Finance, which is an auto compounder, and I'm going to deposit my LP tokens into Beefy. Now, why would I do that? Well, remember back the Uniswap pool, I put my coins in there, and then my transaction fees are sort of building up and amassing inside of the smart contract, inside of Uniswap. But my winnings are not being converted back into pool tokens. So I don't have compound interest going on. My winnings are not being reinvested back into my principal. So what an auto compounder does is it will take your LP tokens, which now give it the right to your coins and to do things for you in this pool, and it will then get your winnings every hour or so, harvest them, and reinvest them back in the pool, thus providing you with compound interest, right? So you can see this is a great benefit to the end users. And this is a great example of two protocols which have nothing to do with each other. They don't communicate with each other. They didn't coordinate this. Beefy just built stuff on top of what Uniswap had built in SpookySwap and made something very useful to sit on top of it. And this is how these things are stackable and composable. Okay, now the other big part of DeFi is lending, so robot banks in the sky, the second pillar of DeFi. So in order to borrow from these robot banks, you have to over-collateralize your position. You have to show up with 1.5x whatever you want to borrow. So yes, that means if you want to borrow $100, you have to show up with $150. And you have to deposit $150 into the robot bank. It'll then let you borrow $100. Now, if your collateral becomes worth less than $120 or 1.2x at any given moment, the robot bank will mercilessly liquidate your positions. So this is, it's capital inefficient because it costs more than what you're borrowing to actually in collateral, right? So it's very capital inefficient compared to the regular banking system. However, it is extremely safe. And as we have discovered over the course of 2022, extremely safe is extremely valuable. We like extremely safe. And this characteristic in these over-collateralized positions is one of the key reasons why DeFi survived 2022 and passed with such flying colors and didn't break and didn't die and didn't go insolvent. Okay, now on the other side, you can participate in the lending by loaning your coins to the robot bank. So you can give it your coins. It will then loan them out to other people. You will collect the interest. In fact, most of the interest on that loan. So here's a very specific example of it in action. This is Aave. This is one of the robot banks in the sky, a lending protocol. On the left, you have the supply side. So if you give GUSD, which I have highlighted there, which is Gemini's stablecoin, if you give your Gemini stablecoin to the protocol to loan out to other people, you will earn 13% APY. So pretty high, right? On the other side, if you borrow GUSD from the system, it'll charge you 18% APY. So it's going to mark it up, roughly 5% there. And these numbers are both pretty high because Aave at the moment is starved for GUSD. It doesn't have enough, right? So so it's got a premium on everything in order to basically drive up supply. All right. Now, the next big thing that happened in DeFi was the invention of something called Curve. And this is a new kind of DEX or decentralized exchange built on top of the core Uniswap idea. Now, Uniswap is really made for volatile coins, so things that are going up and down in value a lot, like Ethereum and Bitcoin. But it's not very great for stables. If you do a large trade, say from Tether to USDC on Uniswap, you're going to lose a good chunk of it to something called slippage. And so, especially if you're moving large amounts of stablecoins around, Uniswap is not very efficient at that. Curve is geared specifically to be extremely efficient at stablecoins and provides extremely low slippage. And what that means is you lose a very, very tiny amount in a trade from one stablecoin to another. So you want to trade $10 million worth of Tether for 10 million of USDC, you can do it and be confident you're not going to lose a gob. Because of this characteristic, Curve quickly became the deepest liquidity pool in all of DeFi. So you can think of it as sort of a decentralized Federal Reserve. And he who controls the spice controls the universe. And if anything is the spice of DeFi, it is Curve. And VE Curve, which I'm not going to get into here, but basically it's the Curve token and the Curve token and its stake state, which provides voting power in the governments of Curve, is control of Curve. And you've probably heard of the Curve Wars. The Curve Wars are to control that voting power. So this is what it looks like. So I have highlighted here something called the 3 pool. Now, just like Uniswap, Curve under its hood is nothing more than a giant number of these pools. And the 3 pool is the second biggest pool on Curve, clocking in at about 600 million in total liquidity. It is comprised of 3 stable coins, right? So this is weird, right? Because before in Curve, there's only 2 coins in a 50-50 ratio. Here you can have any number of coins, and you can have it in different ratios, so they don't have to be equal ratios. But the 3 pool is roughly in equal ratios of DAI, USDC, and Tether. And this is a very, very important pool in all of DeFi. And it's going to be very relevant to our discussion of the death of Luna in a second. So keep the 3 pool in the back of your head. Now, in preparation for talking about Luna, why primarily was UST, which was Luna's stablecoin, worth $1? What made it worth $1? Well, the biggest reason was because on Curve, you could reliably trade $1 worth of UST for $1 worth of USDC, Tether, and DAI. If you can trade it for $1 and something else, it's worth $1. And that's basically the primary reason why it's worth $1. And basically you have to be able to do these trades in massive amounts. So you want to trade 10 million UST for another stable coin, you can do it and back the other direction. Now, as I mentioned earlier, Uniswap needs 50-50 pools. Curve does not. 85-15 or something like that is fine. However, even so, if a Curve pool becomes extremely lopsided, say something like 3% to 97%, then stable coins can start to depeg. So something that should be worth $1 in an extreme out of whack, out of balance situation, something that should be worth $1 now becomes worth 97 cents, 90 cents, 80 cents, and so on. So just keep that in the back of your head because that is very important to our discussion of Luna, which begins now. So now we're going to do the death of Luna. This is Do Kwon, who is the CEO and founder of Luna, who just today was charged by the SEC. So not a good day for Do. And this is his now famous tweet, "Deploying more capital, steady lads," which will probably be on his headstone. So what was Luna? Because it's not really with us any longer. Luna was a fully decentralized stablecoin. So Tether required interaction with fiat banks. In order to mint $1 worth of Tether, you had to put $1 in fiat into a fiat bank account, like Bank of America or something like that. What Luna said was, let's get away fully from fiat bank accounts and let's back stablecoins by another purely crypto asset called Luna. Now, Luna was a speculative coin like Bitcoin or Ethereum, so it went up and down in value just depending on what the market said it was worth. And at the beginning of Luna time, 1 billion Luna are created. And just for you, all you people out there, I'm not certain it's 1 billion. I couldn't totally verify this, but I'm relatively certain it was around there. So let's just say 1 billion Luna were created at the beginning of Luna time. And the rules were these. $1 worth of Luna tokens must be burned to create 1 UST, so $1 worth of UST, the stablecoin. And remember, Luna, when it first started life, was not worth very much, so it might have taken you, 50,000 Luna to make $1 worth of UST in the beginning days. Now, as more and more people did this, theoretically, and as the popularity of UST as a stablecoin went up, the supply of Luna would contract and become more and more valuable, and its price would skyrocket, in theory. And in fact, this is exactly what did happen at massive scale. Now, the other rule was you could go in the other direction. So if you burned $1 worth of UST, you can always burn it for $1 worth of Luna. So you could always go the other direction as well. Now, I personally stayed away from this. I viewed it as sort of a Death Star because it had a single point of failure in the price of Luna. If something bad happened to the price of Luna for whatever reason, I didn't know what, but basically if Luna went down, then the stable coin just completely fell apart. So I didn't like it. I stayed away from it despite a lot of voices in my ear, basically encouraging me to have the opposite view. Regardless, over the course of 2020 to 2022, UST is regarded as extremely safe and conservative. And it grows massively, mostly because of something called the Anchor Protocol. Now, the Anchor Protocol was a UST-based protocol that basically said deposit your UST stablecoin with us, and we will give you 20% APY guaranteed. Right? This is great, right? It's like a bank account that pays you 20% a year on interest. So, and how were they doing this? Well, remember the Luna Foundation printed 1 billion Luna, so they basically had enough. They basically said we're going to cover the 20% APY for at least 1.5 years. We have enough to do that. We don't know what we'll do after that, but have fun for at least a year. And so everybody did. Everybody thought, well, we'll do it for a year and see what happens after that. So most people thought of this as a kind of their bank account, and hedge funds started parking their dry powder in it. And again, the lunatics all thought I was stupid for not being very happy about this situation. Okay, so what happens next is this. Do Kwon, the CEO and founder of Terra and Luna, decides to kind of start acting centralized, perhaps feeling that he has a Death Star. He may have recognized what I did, that he starts saying, I'm going to also back UST with Bitcoin in addition to Luna. So he starts buying up a bunch of Bitcoin, kind of at massive scale. The second thing he does is he forms an alliance with Frax, another stablecoin, and they decide to create something called the 4 pool on Curve. So we talked about the 3 pool earlier. This is the 4 pool, and it's designed specifically to kill the 3 pool and to have UST, Frax, USDC, and Tether be the dominant stablecoins on Curve, and to create the deepest stablecoin liquidity pool of about $3 billion. Remember, the 3 pool is only $600 million, so this is quite a bit larger. If they had achieved this, it would have been massive stability for all 4 coins, and very good for all four coins. And then along came a spider. Now, we don't know who the spider was. Everyone suspects Citadel. We're pretty sure it was, but we can't prove it. So whoever the spider is, the spider comes along and offers Do Kwon $1 billion in Bitcoin for $1 billion in UST in an over-the-counter deal. Do Kwon accepts. This is a great deal. Someone is offering him extremely valuable Bitcoin in exchange for a coin that he invented, right? So this feels like a pretty good deal to him. So, however, he has now accidentally armed his enemy. He doesn't realize this yet, but his enemy now has a very large amount of UST, enough to kill him. The spider then goes elsewhere and borrows $3 billion worth of Bitcoin. Simultaneously, the spider shorts Bitcoin. Now, in preparation for creating the 4 pool, Do Kwon first pulls the 3 pool liquidity out of Curve. So the Curve pool, the 3 pool curve is now shrunk down. And Do Kwon has all of his coins now in his hand, and he's preparing to put it in the 4 pool. So his pants are down, like briefly, during this sort of transition period. And during this window, it only takes $350 million in UST to depeg UST. Normally, it would have taken like around $3 billion. And remember that the spider has $1 billion in UST. So the spider has, roughly 3x what they need in order to depeg UST. So at this moment, of course, spider strikes. So the spider starts dumping UST on Binance and Curve. So the 3 pool is immediately thrown out of whack, right? And so remember what I said earlier, if a pool gets severely out of whack, things that should be worth $1 start to depeg. So UST starts becoming worth 97 cents, then 93 cents. And everybody who holds UST, remember, people thought this was their bank account. They thought this was safe. They start to panic. But remember the other rule. The second rule says you can always redeem $1 worth of UST. Sorry, you can redeem 1 UST for $1 worth of Luna at any time. So if you have UST that's worth 90 cents and you can redeem it for $1 worth of Luna, you're going to get your 10 cents back. So everybody starts doing this, and now they've got $1 worth of Luna, but they don't know what, they're kind of like, I don't know what's going on with this. So they immediately sell the Luna, which crashes the price of Luna. So now you have UST depegging. You have the price of Luna crashing really hard. And at this moment, Do Kwon announces that he is selling Bitcoin to prop up the price of both of those coins. And this is when the now famous Steady Lads tweet is issued. The spider and Do Kwon together, in aggregate, start dumping Bitcoin, $4 billion worth on the market. So this is what caused the price of Bitcoin to crash so precipitously last year. The spider, because they shorted Bitcoin, now makes a giant amount of profits on the Bitcoin shorts. And at the end of the day, when this whole thing is done and all the dust is cleared, the spider profits $1 billion on this whole thing. So the spider made out like a bandit. Meanwhile, the Luna UST flywheel is fully ablaze. The fire is out of control. UST is depegging to 0. So the Curve pool is completely tipped over at this point. And the supply of Luna tokens, as people are redeeming and selling, it goes not back to 1 billion, but it goes all the way up to 1 trillion. And then I watch it go from 1 trillion coins to 7 trillion coins in just a few minutes. So this fully crashes the price of Luna. It's an utter disaster. and it looks like that. So very, very sad downward sloping line right there. And it happens super fast. $80 billion in value evaporated in 48 hours. But we are not done yet. Because UST and Luna have been used liberally as DeFi collateral in things like Aave, robot banks in the sky, etc. Remember I said that if your collateral falls below 1.2x, the robot bank will liquidate you. It'll take your collateral and sell it. So that's what happens. So probably another $40 billion worth of damage was done there just in liquidations. And elsewhere in the world, meanwhile, secretly, Alameda Research, a hedge fund, part of FTX or sister company to FTX, now has massive losses because of all of this. So it decides to borrow customer money from FTX to cover up the hole in Alameda. And this really is what would lead to the destruction of FTX roughly 8 months later. So what are the big lessons here? Well, DeFi worked really great, and centralized things run by humans that are corruptible and not transparent failed. So hundreds of DeFi protocols did not falter at all. They're up right now. They're solvent. They were fully transparent at all times. We always knew what was going on inside of them. Unlike FTX, unlike Genesis, unlike Celsius, unlike Three Arrows Capital, we could not see inside of those things. So the centralized, non-transparent things, their leaders in many cases allegedly committed crimes and failed. So this is very much like TradFi banks. Bernie Madoff was in a highly regulated environment and was still able to commit fraud. It was against the law, but he could still do it. And that's basically what happened here. So this wasn't really a crypto thing. It was just an old school human fraud thing. Meanwhile, the decentralized, transparent smart contracts worked great. They passed a massive stress test. There was zero fraud, zero failure. And in fact, kind of a weird footnote to this, if Do Kwon had not deviated from DeFi with his centralized action, i.e. buying $1 billion in Bitcoin, and just let his mechanism work, even though I don't like it, I do think it might have lived. I think eventually something else would have killed it. And of course, as I record this, this is the day that the SEC is suing Do Kwon. So they just announced that this morning as I record this. So, in the end, he might not have lived anyway, but he shouldn't have acted in a centralized fashion, bottom line. Okay, on to the metaverse, one of my favorite topics. So the metaverse had a lot of revenue. It generated $65 million in revenue, I guess over the course of 2022 mostly. And most of this was whales, so only 65,000 users, so not a large number of people. So these were mostly crypto whales, and they were mostly speculating on land and other things, mostly in the top two metaverses, Decentraland and Sandbox. These two metaverses require you to use their native token, Sand and Mana, respectively, in order to purchase assets inside of their metaverses. These tokens had a big run up and then a giant fall off the cliff. So at the moment, they're not doing so great. And the number of users in these things is not very large. And I'm not going to talk about Roblox. I'm not going to talk about Facebook's Meta. Those things have many more users, but they're also not blockchain things, so sort of irrelevant to this particular discussion. But we can see how many users are using these things because they're on the blockchain. So Decentraland, when I looked in on it during a day last week, had 639 daily users, so not very many, certainly not compared to most other things. My old metaverse, my old jalopy, rundown, used metaverse from the 90s, because the server software, all the software was open source. Well, not open source, but it was just out there. Anyone could run it on their home machine. So I looked in on it on the same day that I looked in on Decentraland, and I found that the Palace had 25,000 users on that day. So trust me, even I am amazed that thing is still up and running after 27 years, but here we are. Sandbox on the same day had 568 daily users. So, kind of the same as Decentraland, and both of them are, they're not big things. Okay, because I found Wi-Fi, which was the coin that ostensibly kicked off DeFi Summer, and Ethereum before that, and a few other early things. A lot of people ask me, what are you doing right now? And this is not financial advice, but I will tell you a few things that I've invested in recently. So the first opportunity, the wallets are really horrible still. Anyone who's used them knows, all of us in DeFi know how to use MetaMask, but it is really just a horrible user experience. It is certainly not ready for consumers. It's very sort of geek centric, so much so that even Kevin Rose, who's a smart dude, he clicked on this. This is actually the actual window he clicked on. He clicked on sign, thinking it was kind of like a terms of service thing where you just you click sign and most of the time it's okay. This time it wasn't, and he signed a transaction to transport millions of dollars worth of value out of his wallet to a hacker. So even the best of us can be tricked by these wallets right now. So an attempt to kind of fix this and to make the wallets more usable by general audiences, Bitcoin Libre is one attempt that I really like. It's a wallet and blockchain. It's available now in the iOS App Store. I think it's also on Android. And it's an attempt to make using Bitcoin and Tether and just those two coins alone as usable as Cash App or Venmo. So the wallet and the app itself has like a 3-second onboard. It has Twitter-like username, so you send your coins to @MarkJeffrey, for example, instead of some crypto address. It has a half a second transaction speed, which is quite a bit better than Ethereum's. I guess it's probably 10 seconds now most of the time, and Bitcoin is like 10 minutes, so quite a bit better than those. It's fast enough now to use at the gas station. Bottom line, and there is a Libre token, which is the governance token for the Libre chain. And right now that token has a $5 million cap, so still very early days on it. I invested on day one, so I got in even lower than that. And Brock Pierce also invested lower than that. We both invested right around the same day. This is a slide of Brock speaking about Libre on stage at a conference in Miami that I spoke at with him about 2 weeks ago now. And the wallet itself has, actually at this point, it's up to almost 500,000 users. So all pretty great. I really like this quite a bit, and I think it could be quite big. The other one I like is a thing called IPOR. You may have heard of the LIBOR rate, which is an intra-bank lending rate. IPOR is the same thing, but for crypto stablecoins, so the average interest rate across all protocols. And the protocol is chasing the 1 quadrillion notational derivatives market, so the largest addressable market on Earth. And the idea is to create kind of the Uniswap of derivatives, where there are a number of derivatives that you can swap. This is the first derivative you can swap, which is a fixed interest rate that can be swapped against a variable interest rate. The IPOR token is used in various ways with this protocol. And right now that token has only a $5 million market cap. So if this is the largest addressable market on Earth, and it's only got a $5 million market cap right now, it's a pretty good asymmetric bet. I think I've taken it. Deus is another protocol doing much the same thing, but the approach is very, very different. And it has only a $22 million market cap right now. So both of these are still pretty low compared to what I think their potential could be. The other narrative I like are DEXs with leverage. So Uniswap doesn't allow you to use leverage. A lot of centralized exchanges do allow you to use leverage. GMX basically will allow you to use up to 50x leverage. They cracked kind of how to do a Uniswap with leverage. And they do it with a pool by providing a pool called GLP, which acts as the counterparty to anyone borrowing coins for leverage. And it turns out that most people who use leverage lose. And it's sort of 80 to 90% of the time. So GLP, that pool is the house that effectively wins all the time. It could still lose. It's possible, but it's very unlikely. So this model works rather well. And the GLP, if you're in the GLP pool, it so far to date has been very, very profitable. So this particular protocol has about a $500 million market cap in its coin. However, I've looked at and invested in a number of its clones. What tends to happen is once somebody cracks a new DeFi protocol on one chain, there's a lot of fast follower clones on other chains that start off with very low market caps. But because the first one succeeded, there's some proven market success there. So following clones is one strategy that I like. So I've done so on multiple of its clones. Okay, last couple slides. What else could go wrong? Well, the good news is that there's almost nobody left to die. The big monsters are pretty much dead already. The leverage has been burned out of the system, with two big exceptions. But me and my friends currently think that neither one of them are in real trouble or any danger of vanishing. And then there's the big boss monster. The first monster is Binance. Binance is about 80% of the centralized exchange volume overall, so the largest on earth by far. Even FTX, when it was alive, was tiny compared to Binance. So Binance is the big one. If something were to happen to it, that would be a material impact on the entire market. However, it looks really solid, and it's in Dubai. It's sort of out of reach of we think of U.S. regulators in most ways. And has protected itself very cleverly and very thoroughly. So I think Binance is here for the long haul, but we'll see. The other big monster potentially is Tether. There have been rumors of its demise for years, and articles like this come out every week and have for almost 8 years or so. My personal opinion is that Tether is probably solvent and has been one-to-one backed by fiat dollars and fiat bank accounts for about 5 years now. Before that, maybe not. It's hard to say. But there's been so much scrutiny on Tether that I think now, and for quite a long time now, they have in fact been solvent and above board. And this is the boss monster, otherwise known as our good friend Gary Gensler. Gary and the regulators, we don't know what they're going to do. Bottom line, there is lack of clarity in the United States, despite what Gary will tell you. Everybody else will tell you that there isn't clarity. And we don't really know what he's going to do next. So we wake up every morning and see what he did the night before. It's sort of the world we're living in right now. During the internet, when the internet first started, there were similar debates in Congress over allowing cryptography, freedom of speech issues, etc. And we ended up with a very sort of hands-off approach, which allowed the internet to be born correctly. And things like Amazon and Facebook and Twitter and all the things we enjoy today basically resulted from the correct decisions that were made legislatively and regulatorily. Regulators made the right decision back then as well. After a lot of debate and a lot of consternation, I don't know that we're going to get that same result this time. It feels at the moment like we're going to get the opposite result. So imagine if the internet were banned and outlawed in the United States in the mid-90s. That's what's kind of going on right now with crypto. If the internet had been banned in the United States, all these things would have still happened. They just would have happened, Google, Amazon, Facebook, Netflix, etc. All would have happened just in other countries. So I that's probably what will happen here if we get the wrong result. So my fingers are crossed that at some point the current direction we're heading in gets corrected, and I think it will. I mean, long term, I think it's impossible that all of this stuff doesn't end up in the right place. But I just don't know how long it'll take for us to course correct and what damage will be done along the way. It's hard to say. You all know that I run the HashPod podcast because you're watching it right now. But this was for the people at the LA CxO's thing at Upfront, so you don't need to see that. And this is how you find me on Twitter. And that's it. That's the presentation. I hope you enjoyed it. This was a lot of fun to put together. And there were a lot of people at the presentation who didn't know much of this stuff. I had a lot of people come up to me and say, all I see is bad news in the Wall Street Journal and, kind of disparaging things about crypto. I didn't know there was this other side to it. And that was kind of weird to me because this is the only side I know, right? So anyway, I hope you found this useful, and I hope you show it to people who may not know about this side of crypto. My name is Mark Jeffrey. This has been Hash Rate. We'll talk to you next time.